Good afternoon. My name is Matt Seifer. I'm the director of the Real Estate Finance Initiative here at Georgetown. Certainly appreciate everybody coming out. This is the first time through for me on the, as it relates to the Luminaries event, and really couldn't be more excited to have, the great panelists that we have lined up for you guys here this afternoon, and then, Ralph Rosenberg from KKR that will be here later this afternoon. This is an important time for our program. This is the first Luminaries event that we have a actual director of the program, which is a great, obviously, step in the right direction. And as a lot of you guys know, I came from Invesco Real Estate before this. I was at Invesco for 8 years, and I ran their underwriting group, was on their investment committee and investment strategy group. And what I gleaned from that experience is what I think underwriters and young professionals need to know to be successful in the real estate industry. And I hired tons of those folks over time and really mentored a lot of them. So I kind of got to know, I think, what works and what doesn't. And while I was at Invesco, I always had this sort of academic thing where I taught at Southern Methodist University in their MBA program, and always kind of did both because I love this intersection of the private sector and the the academic world. So, and I always said to myself too, if I ever got an opportunity to run a high quality program in a great school with a great brand in a major real estate market, I would jump. And that's what happened with at Georgetown here. So I came on board in July of 2012 and have been actually working diligently ever since. And the thing that we're sort of really focused on here, and I just got out of an advisory board meeting that really resonated that with me, is in my mind it's all about application. And Bob Steers, who's going to be up here in a little bit, talked about the concept of beta and alpha as it relates to academics. Beta is what every school teaches. That's just you being in classes and learning. The alpha is the juice, and in my mind that's what you do to distinguish yourself. And in my humble opinion, I don't think enough schools are really embracing that truly, and that's really our going to be our niche here. And the approach really is as I said, is the hands-on application. Okay, so what does that mean? So in this in this room today, we have 6 of my MBA students who have underwritten $500 million worth of real estate for a company in the last 30 days. And they have live transactional experience that they got here. And in my opinion, that is a key differentiator between what we're doing and what other folks are doing. And what the objective here is that we're able to accentuate that to bring more folks here to Georgetown because I think the level of education is just different. So I'm excited to be here because I think we have the opportunity to build something that's really fundamentally different. And it's really going to have a deep root in this private sector area, which is where I've come from. So, and obviously real estate is a highly applied profession, and so having that applied experience is important. So before we move on, I just wanted to thank a couple people and groups. So obviously first is the students. I've had an absolute blast with the students since I arrived in July, and the creativity, the curiosity, the initiative is really inspiring to me. And I've said to my wife multiple times, I cannot believe the creativity of some of these students and really what they're thinking about at this stage. So I've enjoyed that very much, so thank you for that. I would not be here if it were not for Bob Steers, who's going to come up here in a moment. I knew Georgetown was serious about real estate when I saw that Bob was on the search committee for my role, and really have gotten to know Bob over time here as I've kind of worked through things, and his expertise and experience has been key. So I appreciate that very much, Bob. So thank you. And I'd like to actually introduce Dean David Thomas, who will be following me. I'm going to bring him up here in a moment. But also, my experiences with David have been phenomenal, and he possesses this entrepreneurial spirit. I'm sure there's an environmental element as well. This entrepreneurial spirit that is exactly what we need here, in my opinion, and it fits perfectly with what we're trying to do on the real estate side. So his leadership and his insight has been very critical in my development here. So I'd encourage everybody to sit back and relax. We have Ralph, who's just entered the building, so we'll be anxious to see him and hear from him. And, just on the program, just really quickly, I think there's, in the industry today, there's a lot of capital that is going towards core investment, and it's a core-dominated strategy right now. And I think this search for return that we were talking about, as the premise of what we're doing here, and having Ralph here is huge because it's just different than what a lot of groups are doing. So obviously very excited to have Ralph here, and we have a great panel that will actually precede Ralph, but I will invite actually Dean David Thomas to come up now for his remarks. So thank you very much, and thanks for coming.
I'm going to try to be brief so that we get quickly to our program, which is an exciting one. But first, let me welcome all of you here. Students, alumni, partners, those of you who are not connected to Georgetown, it's great to have you here. I'm excited to be here because to me, this is really the moment of our full public launch of the real estate initiative here at Georgetown's McDonough School of Business. And a little more than 18 months ago, I had a conversation with Bob Steers, who I'll introduce in a moment, and about real estate in Georgetown, and I went away and did some research on my own, and it became clear to me that real estate is one of the most vital aspects of our economic life throughout the world. It's the largest real estate class. It is something that in a very tangible way we all experience every day. So to be focused on this area of activity and inquiry, in my view, fits with the goals that we've set for ourselves here at Georgetown to develop leaders who can serve the interests of both business and society. And the effective development, management, evolution of real estate is important to the world. So while we can think of this only in the context of providing education to students, I think what we're doing is providing something that will, if we do it well, help to secure the future. Because the other conclusion that I came to is that we can do something distinctive in real estate here at Georgetown, and Matt has already described his approach, and he's almost understated in saying that we are already doing things in this area that other schools that have been that have had real estate programs much longer than us have yet to do, and I think we haven't even scratched the surface of how this will evolve. As I became committed to this, and I enlisted Bob as my partner, very much with his leadership, we were able to enlist a group of people to give us their time, their talent, and their treasure to help us move this program very rapidly to, I think, a place that it would take many programs several years to get to, and we've already done that. Many of those individuals are here in this room, and they were here today as Matt's advisory board, and I want to thank each one of you for your commitment, because it's also given me the confidence to invest ahead of schedule in the things that Matt has brought up. And one of the things that I think was also clear to Bob and I after we got on the same page with this is we could do a lot of things, but we had to find a leader with a vision to make this real. And I think in Matt Seifer, we have found that leader, not just with the vision, but with the energy and the experience and the perspective to really move this forward. And it's very rare to find somebody with his combination of practitioner and academic talent and orientation. He tries not to tell anybody, but he's actually Dr. Cipher. So he's a real academic. And so with that, I want to turn to introducing my primary partner in bringing us to where we are today, and that's Bob Steers. Bob is a Georgetown alum of the McDonough School of Business. I learned today that he had hid from me the fact that he also got an MBA from George Washington, but we'll forgive him for that. He pointed out that the MBA program didn't exist when he did that. Bob is co-chairman and co-chief executive of Cohen & Steers, a New York Stock Exchange-listed company. Established in 1986, the firm is a leading global investment manager specializing in global real estate securities, global listed infrastructure, real assets, large cap value stocks, and preferred securities. It also offers alternative investment strategies such as hedged real estate securities, portfolios, private real estate multi-managers. If you are in this field, you know Cohen & Steers. They are one of the dominant forces in their field. But something I think is even more important to know about Bob is that Bob is a person who truly believes in giving back. And in almost every way possible, he has served Georgetown University. He's currently the head of the investment committee for the university. He also is the chair of the Board of Advisors here, as well as a member of the executive council that is leading our capital campaign at the university level. Jack DeGioia once said at a dinner that if he had to identify the most important moments of the university and the school, he'd have to talk about Bob's role at each one of those times in his tenure as president. So with that, I want to give you Bob Steers.
Thanks for the plug, David. I appreciate it. I'm going to keep this short because I think Matt and David have covered the most essential points, which is, I'm pleased to say, the real estate initiative is alive, and it is real. It's not a concept anymore. Matt's here. We had our, as David mentioned, our first board meeting just a couple of hours ago, and I think we're well on our way to delivering a large number of alpha-oriented opportunities for our students that they won't find elsewhere. And there's some world-class real estate programs in other schools, and we're not going to try to replicate them, but we are going to try to deliver things that they can't or haven't, and I think we're well equipped to do that. I do want to thank Dean Thomas for the support he gave me as well as the other early movers on this idea. It's something that's been percolating for about a decade, so it took someone who bought what we had to sell to get moving forward. As did Professor Agarwal, who has also played a key part in this, and of course, the members of the Board of Advisors. As David likes to say, they give both their time and their treasure, and without those board members, many of whom are here today, this would not have happened. And lastly, I just want to thank Matt for pulling this all together today. He had about 50 other major priorities going on, but managed to do a great job in coordinating today's event. So, as Matt and I were talking, in the past we've had some luminaries who were really just here for star value, the Zells and Simons, and though we have stars here today, what our real objective was to examine where there is value in real estate around the world today. It seemed to us that in contrast to what we had all been thinking 2 or 3 years ago, where there'd be massive distress and the ability to buy large volumes of real estate below replacement cost, and it would be easy like the 90s. And that has not happened. And in fact, highest quality real estate has been pretty well picked over, although maybe the panel I'm about to introduce will disagree with that. And so the idea was to bring industry leaders from slightly different backgrounds, different modes of investing to talk today about where they see opportunities, not just here in the United States, but anywhere, because it just seemed to us that, in this environment today, you have to be very thoughtful and very scrappy to find great real estate investments. So I'm very excited to hear what they have to say. And so with that, let me introduce today's panel. And why don't you guys come on up and I'll give a little, come on up, have a seat. First, Peter Feinberg. He's going to be our moderator leading the discussion. Peter's a portfolio manager and senior director at Invesco Real Estate, who joined the firm's New York office in 2010. Peter spent 21 of his 28 years in the industry with REIF, rising to the head of portfolio management and head of dispositions in the Americas. He was also a portfolio manager for several REIF funds, as well as an acquisitions officer. His transactions history exceeds $4 billion, and he's a member of the firm's investment committee and investment strategy group. To Peter's left is Larry Owen. Full disclosure, when Larry was running the real estate portion of Stanford University's endowment, he was our first client. He walked in our door unsolicited in 1986 and found us. So Larry retired from Stanford University in 2006 after 35 years. During his career at Stanford, Larry managed 287 different investments for the merged endowment pool. Total net equity invested was $4.8 billion and resulted in a total net return to Stanford of $3.1 billion. That's roughly 3 times the size of Georgetown's total endowment, by the way. Currently, he serves in an advisory capacity to a number of firms, including Lone Star, Divco West, Parmenter, Green Oak Real Estate. And at the risk of embarrassing Larry, during his career at Stanford, he was known as the most successful endowment real estate investor in the country, bar none. To Larry's left is Jim Corll. Jim didn't mention this in his bio, but he did work for our company for a number of years, and he was chief investment officer for us. Somehow it didn't find its way into his bio here, but but Jim is a managing director at Siguler Guff. He joined the firm in 2009, and Jim oversees the firm's distressed real estate investment activities and developing investment strategies, portfolio construction, and identifying investment opportunities, as well as monitoring his real estate portfolios. And he's a member of the investment committee for various funds. And Jim, of all of the real estate co-investment fund-to-funds, has raised the most and put out the most of anybody I'm aware of over the last 5 years, which is a period of time when it's been very difficult to raise money for that mode of investing. And then lastly, Steve Steppe. Steve is head of Stockbridge Capital Group's core and value-added business lines, and he oversees the firm's separate accounts and strategic advisory business. He's also actively involved in new business development and acquisition activities. Steve has more than 40 years of real estate industry experience, and he was formerly managing director and chairman of REIF North America, and an active member of all of the firm's key North American investment committees and fund boards, as well as their Global Securities Strategic Investment Committee and Global Investment Committee. So as you can see, we have the endowment, the intermediary, the investor. We have a great, I think, range of experience up here, so I look forward to hearing your thoughts on where the great real estate opportunities are today. Thank you for being here.
Thank you, Bob. We appreciate the introduction. So the subtitle of this program is The Search for Yield. And the good news, just to start out with good news, is that real estate stacks up pretty well. So the NCREIF index recently has had about 6% income yield, and when you compare that to today's 1.8 Treasury or sort of the 2%, just round numbers, it's a 400 basis point premium, which historically is a very wide premium. So for CIOs looking to get yield, real estate does a good job, at least at the outset. The question, I think what we'll cover and explore a little bit in this panel is it good enough to be relatively high yields relative to the other asset classes? Is there durability in those yields? And I think in the debates that go around the industry when trying to figure out the answers to those questions cover lots of areas, including which property type do we get into, what demographic trends and other cyclical trends are going to favor one property type versus another. How much leverage to use. The most recent experience at the global financial crisis was leverage can be a fund-ending and career-ending kind of event, but yet with the spread to treasuries, it's pretty compelling today. And then there's questions about what vehicle to invest in. How much control does an investor need? So these are all questions that we'll explore. I'll start out with a few questions for the panel, and then I think we'll have some time at the end of the session to have some questions from the audience. So think about what you might want to cover. So Steve, let me start with you. So the coming out of the global financial crisis 5 years ago, core was king. So it was kind of a risk-off event. Everybody flocked to core, and core got to be known as gateway markets, a really small number of markets, smaller than I think some of us have invested in the past. Try to speak without the mic. Okay, but since then and more recently, there's a question: is core and core gateway overpriced? Let me turn it over to Steve. So the question is: core overpriced, and if so, what are the alternatives to traditional core that an investor can still keep a low risk appetite, but get decent returns in today's market?
Be nice to me, even though I can't fire you anymore. So. I think comfortably say after 35 plus years of being in the business that I have no clue as to the answer as to whether core is overpriced. I can tell you this much: trophy, core, and gateway markets don't even come close to the returns that we're trying to generate for our clients. So I'll give you a little metric. I think when you're an investment manager and you're dealing in the institutional marketplace, our clients are corporate and public pension funds, very few endowments. Endowments tend to think of real estate competing with private equity and venture capital and generating 20% returns. I hope that's not Georgetown's approach to real estate, but I'll leave it at that. Our client base comes to us and hires us to deploy their capital in the sector, and they look at a long-term investment in an asset class where maybe 10 to 15% of their investable asset base is going to be allocated to the real estate sector. So what are they trying to accomplish? And as an investment manager, what are you trying to accomplish to make sure that they want to continue doing business with you? They expect a return somewhere lower than equities, public market equities, and somewhat higher than fixed income, whether it be the whole specter of the fixed income space. So to us, we're trying to generate real rates of return somewhere between 4 and 5% above inflation, holding assets for 10 to 15 years. So what we're trying to do is also help them get to their objectives of their overall return for their fund, which means real estate has to generate, after fees, somewhere between a 7.5% to 8% long-term return. And if we can't do that, then they'll cut allocations and find other ways to invest money, because they have to try and meet, and there's an interesting article in the Wall Street Journal today about return assumptions for pensions and how maybe they can't be achieved, which I think is probably true. But at any rate, we're to help them generate performance in the portfolio. And for us, that means unlevered, we need to buy at 7.5% to 8% unlevered IRRs. We use 30% debt, 70% equity to get somewhere close to 9. Unlike KKR and others, we have meager fees. We charge charge about 1%. We take about 1% of that return in fees. So after fees, we're trying to generate about an 8% total return over a long period of time. Whether gateway trophy assets are overpriced, if you are a sovereign wealth fund and you think the US dollar over the next 10 years is going to vastly outperform your own country's currency, and you want to be in hard assets that have some inflation hedge, and you're willing to live with a 6% IRR and a 2% 10-year measure, 10-year treasury, that's, I mean, I don't know if that's overpriced. Seems to me it's still maybe okay, but that's not the returns that we're looking to generate.
Well, that's helpful, Steve. We'll explore a little bit more of that in detail. So, Jim, I have one for you. So in value add and particularly in opportunistic space, vintage year is very important. There are funds that have just had, remarkable vintage years, and then there's the recent crop in 2008, 2009 that have been subperforming. Jim, does vintage year apply to all real estate investing, and is it the advisor who should be making those decisions, or does the plan sponsor who allocates capital expect that capital to get invested?
Well, I think if your advisor can't tell you whether or not it's going to be a good year to invest or not, then it probably shouldn't be your advisor, right? I mean, it's like kind of like my stockbroker calling me up and saying, "Hey, Jim, can't really determine whether the market's cheap or expensive, but just keep shoveling me that money every year, and we'll put it to work for you, and don't worry." So, I mean, our investment mode, our view is really that I think one of the things that real estate investment industry gets wrong most of the time is it's fundamentally people concentrate on the alpha, and the beta oftentimes is much more important. It's very I'd be hard pressed for anyone to come up with an example of something they bought in 1983 or 1993 or 2003 that didn't make money, right? And likewise, I think would be hard pressed to come up with something that someone bought towards the end of the 5 or 6 years later, late 80s. A little bit less so in the severity in the late 90s, and certainly in the mid 05, through Lehman. So I think this is the single most important decision you have to make. Everyone's kind of diversification pie charts, this property type, and and this geographical diversification didn't do anyone any good, right? If they got the timing wrong. So I think the biggest arbitrage opportunity out there is not the difference in value between building A and building B. It's the difference in value between building A at the bottom of the market and the value of building A at the top of the market. And if the advisors don't recognize that and don't place that consideration ahead of their own sort of concerns about having fundraising be a continual operation rather than an episodic operation, then they're going to continue to sort of have those big problems.
So Larry, you were a former plan sponsor. You had advisors coming to you for money. Do you agree? Was it you gave them money? Did you expect it invested, or were you okay?
Actually, we did it a little differently. We actually were almost exclusively separate accounts.
Okay.
Deal by deal basis,
Right.
and we approved each one. So we didn't give anybody any money, and they always had to come, except for Steers.
That's
But
good.
that was liquid,
That's good. So you kept some responsibility along with your advisor.
Yeah. Most of our rules were well located, below replacement cost, not marketed by Eastdil. You get Eastdil to sell it. You buy it from, like a family where the old guy's dead and the kids hate each other. You buy that. Or somebody that's had land in their family for 50 years, and
Sure.
it was mostly below replacement cost, well located, and I don't like gateway cities.
Okay. Well, let's explore a couple of the property types, and there are, for any investor, there's conflicting signals, and everybody's watching both optimistic and pessimistic signals. So for office, we have record corporate profits. Corporations are healthy. Balance sheets have been repaired, and there are a few drivers of certain economies, technology, certainly healthcare, energy. So you all can think of markets where those industries are thriving and office markets are doing well. But we have this countervailing trend where people are just using office differently. Space is getting more efficient. People talk about collaborative space, and Google and others are just doing things differently. But the net effect of doing it differently is a much smaller square footage per employee than we've had when all of the old folks sit in their corner office and other offices. So, Steve, I'll start with you. So, office, does it make sense, or is there a long-term trend against it?
Beware of anybody that generalizes about any property type, because it never makes any sense to make general statements about a property type. But if you look, historically at investment performance in office, you buy it, as Larry says, below replacement cost, well located, close to nodes of commuting that offer people an attractive environment from their home to office. And then you sell it to someone who you hope is dumber than you are, because you never make any money off the cash flow. It's an asset class which we historically have always underweighted. We like to see 70% of our overall projected return on distributable cash flow off an asset that we own. Cash flow doesn't go away, except in the office sector, it vanishes overnight. So there are great opportunities in office when you can buy substantially below replacement cost. You can pay low cap rates for depressed rents. The people that bought in the Bay Area, which we were fortunate to make several investments at the depth of the cycle on very depressed rents, and you buy at low cap rates on depressed rents, and you're still buying substantially below replacement cost. The problem is when the rents escalate, which they now have, and people then are buying escalated rents at 4 and 5 cap rates, and they're paying over replacement costs. To me, that is a great way to lose money.
Fair comments. So Steve, you said that you can't make money on the cash flow from office because the capital that it takes to keep tenants in the buildings just kind of eats away all of that. So other property types are different. And Jim, I want to go to you on apartments because mainly because you've been on both sides, public and private. And a couple years ago, apartments were clearly the darling of the public real estate universe, and the trends were clear. The age cohort from 25 to 40 that tends to rent apartments was spiking, and still is, although the rate of that growth is moderating. And there was just sort of a trend away from home ownership. The sexiness of home ownership kind of went away after people started losing homes, and there's just a bigger renter by choice cohort. So that was, call it 2 years ago, and that was a pretty easy investment both on the public and private side. But in the best markets, the best rent growth is probably behind us, and and there's new construction. So, Jim, kind of a two-part question. The public markets have in the past predicted the future. The public markets are now showing depressed prices on the multifamily REITs. Where's it going? Is multifamily still a place to be? And is there other opportunities there? Is really the question.
Well, I think the most dangerous word in the investment business is the word still, because people will look at something and say, well, look, there's still going to be 4% rent growth, even though it's 5% rent growth, and that's still sounds pretty good. But the fact is, it's decelerating. We spend a lot of time in the public market side looking at what we call the second derivative, and you got to keep your eye on that, because when the second derivative goes negative, multiples contract.
Right.
And the reality is, the apartment story is very well told. Everyone, you can pick up the newspaper and read about it. Everyone knows about it. There's been plenty of capital flow on the equity side, plenty of capital flow on the debt side. The debt never went away. Fannie and Freddie, kept, the debt never receded from that marketplace. And the valuations are rich. I like to talk about real estate in terms of the EBITDA multiple when I, talk to potential clients and sort of non-real estate people. And when you talk about EBITDA multiples as you're looking at, a building is a business, and you look at some apartment building on the West Coast or the East Coast, some of the favored, markets among the core guys, they're quite happy paying 20, 22, 25 times in some cases EBITDA multiple. And, I don't know if there's any stock guys in the room, but like how much growth would you have to see coming off of a company to pay 20 times or 22, 25 times EBITDA multiple? I mean, maybe like JDS Uniphase in 1999, you would be willing to pay that because you knew it was going, or you thought it was going to 30 times or whatever. But the reality is rich. And when you're growing rents, 4% a year, and that's declining, you got to grow an awful lot to grow your way out of a 20 plus times EBITDA multiple. So I agree with Steve. You can't paint any property type with a broad brush. And despite my comments about, I didn't say alpha doesn't matter. I said beta trumps it a lot of the time, a whole lot of the time. It still matters. I'm sure there's undiscovered, but they're probably real small and very niche-y, and there's some kind of angle. But I'd say most of the institutional business on the real rental side is played out. Everyone knows. And by the way, the construction's coming. The single family guys are coming, which is no one is kind of doing all the math and adding up that massive pipeline. And we've had a one-time shift in demand, big drop in the home ownership rate. That's over, right? There's no more 4 million households getting dumped on the front steps.
Right.
So yeah, it's definitely played
Although
out. Public companies show that.
Couple things just to push back. So all this has happened without job growth, right? So traditionally the apartment market wouldn't have done so well if it weren't for jobs being created. So and you may or may not have an opinion whether that's coming, but there's the earlier side of that 25 to 40 age cohort that are living with their parents, that are doubling up, tripling up, and so the optimist would say there's all sorts of demand out there that hasn't sprung yet. And then the construction side, and we'll see in a year or two, but the permits are still below the prior averages, not even prior peaks.
But but every vector is going in the wrong direction, right? The permits are accelerating. They're not going down. They're only going up. The single family guys are coming in with competition. And look, at the end of the day, it's not just about fundamentals. It's about fundamentals in the context of valuations, and who wants to pay 18, 20, even for not coastal markets 18 times. It's
And one
too
thing we
rich.
haven't mentioned, it's the most heavily financed asset class in commercial real estate as a percentage of debt to equity. So it's another Fed-led bubble in the apartment sector due to the interest rates that we've all.
Yep.
So the pricing in apartments, when you think about increasing rates at some time in these kids' lifetime, I don't know about mine, but sooner or later we'll have increased rates, and it'll affect the multifamily sector far more than other sectors.
Well, it's a great point, because we've always said, we'll pay the low cap rates when there's lots of growth, but even without growth, call it the private guys, will pay the low cap rates when there's debt that's accretive. So, it's kind of a different competitor that looks at different things than we do.
The thing most people do with apartments, though, is grossly underestimate CapEx. They say a new apartment, so you won't have to spend much money for 3 years. But after 3 years, if people move in, they move out. That costs money. And
Right. Yep.
I've never seen an underwriting that really got up there to what it actually cost.
That's a fair
It's
point.
kind of like office, right?
And that's especially
TIs
true.
and leasing commissions are like.
It's especially true for these single-family rental guys. If
Yeah.
you look at what they're
Oh,
projecting,
God.
they're going to be able to they have no idea what their margins are in that business. They have no idea what the CapEx requirements are. They're in for kind of a rude shock. But they are adding to they are adding to the supply, and they'll start taking away from rental growth.
Do you think that's a long-term business, or do you think that those guys are really doing that to sell?
You got to listen to what they're doing, not what they're saying. And I would say that, I mean, we met with everyone I can think of doing that, at least a dozen people pursuing that business plan. There was not one guy that knew what the right operating margin was for a regular apartment community, right? And then if you got your maintenance guys, got to know how to fix 50 different types of dishwashers, and got to go mow 300 lawns, and and it's just, there's no way the margins are better. But these guys are coming in telling you the margins are better. There's not one guy that came in that has a real operating background in multifamily. They're all guys that want to say, oh, well, we want to go to buy a bunch of stuff because it's for sale, and it looks cheap, and they'll make some money. I mean, there's lots of serial correlation of returns in the housing market, but it's playing a bounce, and they'll make some money, but it's not going to be what they think it is.
They're really good at computer modeling.
Right.
Okay, so we have office that is really a value-add asset class because you don't make money on cash flow. We have apartments that, Larry has reminded us, that have more capital than you kind of think. So actually, when you do the research over long periods of time, retail has had the best income returns with the least volatility, and there's a few reasons why, and there's a lot of differences within the retail broad asset class. So here's what's going on now. So for every 1% increased market share in online sales, which I'm sure everybody in this room has participated in, there's 1 million square feet of stores that don't need to exist anymore. And last I looked at it, there's 9 or 10% market share, so it's not insignificant from the online competition, but it's still small enough to expect a lot of future growth. Right. So what are the plays?
That's where you need the specific. I go to the same grocery store every day on my way home.
Right.
Right?
Right.
And I saw this thing at the Stanford Shopping Center that I couldn't believe. It's called the Dry Bar. And it's where very wealthy women come in and have their hair blown out. They don't shampoo, they don't color, they don't set. They blow your hair up for $35 a pop. The place was packed.
They do your hair, Larry? They do your hair there?
Yeah. They do mine for free, though.
I'll bet they do.
I'm their model.
So outside of Stanford Shopping Center, which I'm sure any of us would buy at a reasonable price, what else is there? Steve, any thoughts on what you'd buy in the retail space?
Well, I mean, we're under contract with a shopping center in Portland. We're under contract with a shopping center in the East Bay of San Francisco. But it's all grocery anchored. It's not big box retail. We are extremely concerned about that space, and we think there's going to be a lot of fallout. I'd be interested to know in the public market how these guys look at a DDR and get comfortable that they're going to have any kind of NOI growth with all that's going on. I mean, I just don't see it myself, but I think quality grocery anchored shopping centers, and unlike other asset classes in commercial real estate, retail is dependent upon a specific trade area and its competition within the trade area and what future competition may be within a specific trade area. So you can buy great retail in what people would think as non-core markets, which I think Portland is a good example. We wouldn't consider Portland a market that we would buy most any property type other than apartments and retail. But high quality retail is so dependent upon the trade area and the tenant mix, you can go a lot of different places.
I think the thing about retail is, the worst real estate you could possibly own is bad retail, and the best real estate you could possibly own is good retail. So the risk profile, the spectrum of risk, and attractiveness of retail as a property type spans, all the other property types, right? And so, your question about the internet or whatever, shopping, and I think all that does is it makes the good better and it makes the worse worse. That's all it does. It spreads it out along the spectrum. The best stuff is going to be the showroom, is going to continue to be the showroom. Obviously, there's certain uses like Larry can't get his hair blown out on the internet. Not yet anyway. So, but for the worst stuff, the other end of the spectrum, the BDRs, they got a tough, when you're out at exit 62, it's a tough road to hoe out there, You're looking at, so it's hard to generalize, but I think that's the impact that technology has. Just spreads out, just pushes it makes that broad risk profile even broader.
Fair point. So we won't have time today to go through any kind of broad array of markets, but we are sitting here today in Washington, D.C., which probably for 20 years has been in the top 5 markets for the AFIRE, Association of Foreign Investors in Real Estate, and I'm sure ULI's list and others. But we've got issues, right? We've got sequestration. We've got all sorts of pressure on any number of branches of the government who are directly and indirectly space users in this market. I don't think it's number 1 on those lists anymore, but where do we sit? What are the plays left in D.C.? Is it still a place that we should be? Larry, what do you think?
I would never short Washington, D.C. office.
Yeah.
It doesn't matter if they want to, there's no way. It just keeps growing and growing and growing. And so, but you still have to be well located, and you can't pay above replacement costs for somebody who'll build another building that's 12 stories high.
I'd say government's a growth industry, but everybody knows it, right? So there was no, we wound up buying nothing here because there was no distress. Oh, well, some guy said, this one's a little bit, but the magnitude of the distress, capital receding from this particular marketplace was nothing like, because everyone knew it, right? Everyone knew the government's stable or growing, grew throughout the downturn, and for better or worse, it's a growth industry, so.
I guess I would have a contrary view. I am pretty negative, over the next couple of years. I don't think we'd invest in this market. I think there'll be substantial defense cutbacks that will really affect this market. A loss of jobs. I just think there are much better places to place your capital over the next couple of years in this metro area. After that takes place, I think you'd load up on it.
Right.
Yeah, it's such a liquid market that when things get really bad, cap rates went to high 7s for about a quarter or
Right.
2, and then back down. Interesting. Well, hey, Jim, we talked about it for a minute, but I want to go back to the public versus private, and there's a lot of pension fund money out there, and the big funds are using lots of different vehicles, but are the public markets viable for these larger pension funds to invest in? And if so, what are the pros and the cons of investing through the public market versus directly?
Well, I think ultimately the core business is going to be replaced with publics. I think, is it viable? It should be the preferred way to get your core exposure. I think there's something very interesting happening right now, which is that public owns 20% of the real estate in the U.S. and have done 50% of the fundraising, right? About like a record high in 2012. And that's been accelerating the last several years. It's on an uptrend, and you've had about the same on the private side. You've got that owns 80% of the assets, and the private side's also raised about $50 billion. It's been flat as a pancake, around 45 to 50 billion range. And what that tells you is that basically people like real estate, but they don't like lockups. They don't like giving. It turns out that the value proposition of giving a manager discretion for multiple years and not having anything to say about it, has not proven to be a good one. So I think people are voting with their feet, and you see. There's no question the private market right now, I put it bluntly, is getting spanked. The people do not like the structure. Deal with that every day. Talk to people they're still smarting from those big, huge funds they bought into in 06 and 07, and they don't want to. They do not like forfeiting the discretion. And the public market is being rewarded. And I think if you look back, in my view, the reason is because if you ask yourself the question, what was public versus private? What were they doing in 06 and 07? You know, when there was an obvious, overvaluation, the public markets were selling, right? Dozens of companies were taken private by guys using more leverage on the private side who thought that for a moment in time they had a lower cost of capital, but it was illusory, right? And so you had a huge shift in assets from public to private, and now it's going the other way, and that's why. Because you can argue with me conceptually about I wouldn't write off private or whatever. I'm not writing it off, but the reality is the capital flows are what they are, and I think given what I've seen, they are what they are for a reason.
One quick follow-up. So for the biggest investors, Jim, in the country, CalPERS and New York State teachers, is the market cap for the public companies big enough for those guys to invest in a meaningful way?
It's been an impediment in the past that they've historically kind of looked at and said, well, I don't know, that's a $300 or $500 billion market, whatever it is, and do I want to be 2 or 3% of that marketplace if I'm going to shift? And so yeah, there's no question that's given people pause in the past. But as it grows, I think that's a problem that gets smaller and smaller over time. You look at Australia, 50% of the assets are in public hands, and anything you want to own is in public hands. And I think because of the efficiency of that model, for core, because that's kind of what they do best, I think the best operators are generally the best operators, not necessarily the best investors, but the best operators are public. It's a better model. I mean, not because they're smarter. You're not smarter just by virtue of being public, but the envelope works better for operating real estate. So.
Okay, Steve, what's your thoughts on the public versus private debate for core real estate?
I think 25 years ago, Barbara Cambon said, pension funds are going to do core in the public market, private market's over with. I think we have a queue to get into our open-end fund. I think UBS has $2 billion trying to get into their open-end fund. You guys have a queue at Invesco to get into your open-end fund. So the pension funds are voting, with new capital to stay in a vehicle in the private market. Jim makes a lot of interesting points. We bought, as Peter knows, when he was with me at REEF, the REEF market was depressed. We bought Cabot. We bought Pacific Gulf Properties, 2 public companies in the REIT market. We took them private, and CalPERS made $1.6 billion in realized gains. So these things ebb and flow in terms of where the opportunities lie. The public market can get depressed for reasons not related at all to real estate, and then the private guys will take advantage of those times. And then there are times that the private markets get ahead of themselves as well. So both markets are going to exist for a very long time. Both markets, I think, do a lot of good. I think the public market is by far the best vehicle for the DC market. And, that's where DC plans should be investing their capital. Why would they be in private markets? That makes no sense to me.
I just want to comment on the queuing thing, because to me, I can't look at that and say that's a function of the health of the market, right? I think that's a terrible thing, right? To be in a queue to get invested. I mean, I remember we did a panel at PRIA in 2006, and the guy, the head of a big consulting firm, got up there and beat his chest and said, "There's 40 billion, queued up to buy, core real estate." And let me tell you, if you walk down to the floor of the New York Stock Exchange and say, "Hey, I got 40 billion to buy," guess what? You're going to get scalped. And those people that bought 40 billion in late 05, 06, 07, the queue that a pension consultant who will remain nameless was all happy about, it was terrible. It was a terrible sign. There's no one waiting to get invested in the public markets. You can execute today, and waiting, it's I don't know. I think it's very dangerous.
It's good for the investors. I don't think it is good for the investors to be in a queue and wait a year and a half to get their money invested. you know, I don't think that's good for the investor. I don't think it's good for the sponsor. I'm just telling you, I live in a factual environment of, you know, what's happening.
Well, no, look, capital flows are accelerating on both sides. And I think although private capital has been flat for the last 4 years, it's definitely going to go up. People are coming back to real estate. But I think it is noteworthy that the flows are really accelerated. And if you look at more assets here, you know, the public with their 20% is raising as much capital as the private with its 80%. It's interesting. You know, it's a shift going on.
Yeah, no, good thoughts. So Matt, I don't know if you're keeping time, but maybe it's time to see if there's some questions from the audience. Do we have time for that? And do we have microphones? Looks like set up. So, gentleman right there. I don't know if you want to go to the microphone or if you.
See if I can speak up, but I am seeing long-term tenancy changing with regard to or around FASB 13 and capital versus operating leases, and it's affecting financial structures and therefore potentially asset valuations. If it's implemented, it sounds like it's on, I guess, the next few years. And I think more guidance is coming out shortly. I see the potential for shortening of lease terms and therefore a shrinkage in asset valuation in that. And I was wondering if, for me, it feels like a frightening potential seismic shift, but I wanted to see how you may view it yourselves in your respective roles.
Anybody focused on that?
No, I have have a hard time dealing with the SEC and their regulations, so I'll leave that to the controller and the accountants. I haven't seen nothing has risen to my level that would cause a concern at the moment.
It's funny, I wouldn't think that the shorter lease terms by themselves would be detrimental to values, although it could be in certain circumstances. But we have markets in parts of Asia or 2-3 year leases for office tenants, and that works just fine. Apartment markets in the United States have always been 1 year or less, and it's not a detriment to value. So just it marks to market more frequently, which is again not necessarily a bad thing. But I think the industry will still see how that plays out when it happens. Anyone else have questions, thoughts?
Hi, Jessica Flugie. Just a simple question. I liked your point, Larry. I wondered if you guys could just talk about how you approach your CapEx planning. Is it asset by asset class, or is it a global pool? I'm just really curious about that. The CapEx planning for replacement.
That's a good question.
No, I mean, it's a critical part of an underwriting process, and Matt, I'm sure, can tell you. I mean, you have to be able to underwrite reasonable capital expenses during your holding period, and a lot of it is, a lot of it varies on what property type, obviously, that you're dealing with. A lot of it depends on when the rollover occurs and what type of market you're going to be in when that rollover occurs, which is very hard to anticipate. So, you make reasonable assumptions based on past history and experience of what it takes to keep and retain tenants in terms of capital, and you build that into your cash flows and your expected total return. And, sometimes you're lucky and sometimes you're not so lucky, and it affects returns a great deal.
I don't think you can overestimate CapEx, especially on apartments. Right.
It's the only property type that we haven't talked about, which is by far the best. You could only invest in one asset class. You'd invest in industrial.
That's right.
Just on the capital question, one more is, you still have to win the deal, right? To Larry's point, you can't underestimate capital, but you still have to underwrite to the point where you actually win the transaction. So what's
Right.
the balance between those issues in your mind?
It's more of an art than a spreadsheet. You have to, like in offices, you need to know the office manager's birthday for the big tenants and send flowers. You need to do all that stuff that a lot of people don't ever think about. And short-term leases are good as long as the tenants are paying for most of the CapEx,
Matt,
like in China.
your point's a great one. I mean, most of our firms spend an awful lot of time and effort to create 10-year capital budgets that have the director of engineering and the property manager and the asset manager's input, and then when it comes time to transact in that real estate, those kind of get thrown in the trash can, and rules of thumb on 25 cents a foot or $400 a unit kind of come into place, because that's the norm. And I think a little bit to Steve's point, so if you have to do that, you want to make sure that that norm that you're underwriting to quote win the deal is more or less based in reality, and if it's not anywhere close, which means that your asset is older or needier in capital than everything else, then maybe that's not the best asset to buy. And if it's if you're going to do better because the norm that gets you to win the deal is less than you have to spend, then that's a pretty interesting opportunity.
And the other thing is you have to do the CapEx. I mean, we have a roof reserve at our home, so if our roof ever, no. That would be a cash expense.
Yeah. What else? Can't see it in the back there. Is there anyone in the back with a question? Good. Time for one word? Should we wrap up? Yep. Okay, good.
Thank you.
I want to thank the panel. Appreciate everybody's comments.
Great, thank you, guys. Okay, for our next panel, we are delighted to welcome Ralph Rosenberg with KKR. We thought that inasmuch as KKR is not known for real estate, at least not yet, that the fact that they're making a significant commitment to this area at this point in time, it would be fascinating to hear what their take is on real estate in the United States today. Ralph joined KKR in 2011, and he's the global head of KKR's real estate platform. Prior to joining KKR, Ralph was a partner at Eaton Park Capital Management, and he also managed his own firm, R6 Capital Management, which later merged into Eaton Park. Previously, he was a partner at Goldman Sachs, and he's a former member of the Stanford Graduate School of Business Trust and is an honorary trustee of the Francis W. Parker School in Chicago, Illinois. His two partners in crime are first Marty Chico. Marty's main claim to fame is he is a parent of a daughter here at Georgetown and will have a second child here next fall. Beyond that, Marty is a senior managing director at Evercore Partners and is responsible for the firm's real estate advisory business. Prior to joining Evercore, Marty spent 29 years at Merrill Lynch, ultimately serving as vice chairman of global commercial real estate and global head of real estate investment banking. Over the course of his career, he has been involved in a broad range of transactions throughout the real estate and hospitality sectors, including numerous IPOs, capital market, and M&A assignments. And then last but not least, we have Matt Seifer. For those of you who don't know Matt, he brings more than 9 years of industry real estate experience to Georgetown's McDonough School of Business, where he teaches as professor of practice and directs the school's real estate initiative. He joined Invesco's Real Estate Acquisitions Group in 2005. While at Invesco, he was responsible for the oversight of the underwriting group, which acquired over $10 billion worth of institutional real estate during his leadership tenure. Matt also was a member of Invesco's investment committee and investment strategy group. So with that, would you please take the dais here? Thank you.
Well, thank you, Ralph, for being here. This is great. I've been, very excited to talk to you just as a part of the, just to hear more about your strategy in terms of what you're doing at KKR, given just the massive amount of, core capital and sort of the herd mentality running into the same markets and the same product types. And, I hope you could take some time and really walk us through the KKR strategy.
Sure.
And I saw you just closed on a mall, I think April 5th up in Albany, New York. So, the tertiary markets, you're in, development, sort of repositioning, all sort of manner of product type. And I think it would be fascinating juxtapositioning really what you're doing in your approach with sort of the core strategy that's really been so dominant in the market today.
Sure. Well, thanks for having me, first of all. Just to take a step back, KKR decided to go into the real estate business back in 2011 and basically took the attitude that coming out of the financial crisis, there were going to be lots of opportunities over the next 5 to 10 years for somebody with access to a lot of capital to provide solutions in the real estate capital markets, both debt and equity, and really, quite honestly, to take market share away from a lot of the bad actors who were managing money in an imprudent fashion in the bubble. And so KKR decided to effectively leverage its brand and its franchise to jumpstart that business, and that's when I came into KKR. So with that background, the direct answer to your question is as follows. When you're a global like ours, like we are, with a global brand, and you think that brand can actually access deal flow, then you can turn on that faucet of the brand and create a lot of interesting deal flow in an asset class that historically KKR really was not a player in. And so what we do every day is we think about how does the KKR information flow, sourcing channels, and operational expertise create differentiated opportunities in the real estate space. So if you actually map call it 10 transactions that we've committed capital to in the last 2 years, which approximately responsible for about $700 million of equity and call it $1.5 billion of gross asset value. Each one of those acquisition opportunities comes back to a roadmap of how either the KKR brand helped source, gained access to information, or had operational expertise that created something other than quote unquote buying the market.
So could you, I think one of the, the best and most interesting examples for me anyway is the Williston, North Dakota investments that you're making. So if you could explain a little bit about that and just how that came about, I think that's a great example.
Sure. So to make a very long story short, we have a very prolific energy investing business at KKR. We have multiple energy platforms in our private equity businesses, and one of the strategies that we embarked upon when I came into the firm was really to connect the dots across the private equity verticals and to find where there was connectivity to the real estate asset class. And so when you think about what's happening in the shale exploration, in this instance in the Bakken shale in the Dakotas and into Montana, we were seeing data in our own portfolio companies that suggested that the proliferation of energy coming out of the Bakken shale was going to be literally multiple decades into the future. And when you start thinking about how to connect the dots with those types of observations to the real estate asset class, very quickly you could conclude that there was a dramatic undersupply of permanent housing to support the workforce and also the support infrastructure to actually build a sustainable economy. And so a long-winded way of saying that in Williston, North Dakota, where we have a investment where we've committed about $150 million of equity, there is a permanent housing supply of about 6,800 permanent residences. And there currently is a permanent population of about 25,000 people. And the estimates are that that 25,000 person population is going to grow over the next 5 years to 50 or 60,000. And so we actually took the position that if we really believed in the conviction that we were seeing in our energy platforms, that this was really a sustainable economic environment, Then we took the position, by definition, in the real estate space, that we thought we could capitalize off of that conviction and create a permanent housing stock in this city and help the city effectively grow into a more sustainable, mature, socioeconomic climate.
And
All driven by demand, huh?
It's all driven by demand. I mean, there are two sides to the bet, right? And there are people who would say it's a binary bet, right? You're effectively making a bet that shale exploration is going to continue, that fracking is going to stay viable, and in life, we all look at the information that we all have on our table, and we assess what the risk reward is of acting on that information. And so when we looked at the information that we have available to us, that's real time coming out of our own companies, and the fact that we've got, for example, the chairman of Hess Oil sits on the board of KKR, and so we got access to all of John Hess's information as well. We basically concluded that the risk reward merited us making the investment.
so I think you just got back from Asia, is that correct?
Yes.
So can you walk us around the globe in terms of, what your, when you think about just a, global investment strategy, and, I think you made one investment in Europe, but, what does that look like in 2 years, 3 years? What's Asia look like, and where are you sort of focusing from an investment perspective today?
So I'll preface this with stating the obvious, which is it's really, really hard to build a global real estate investing business. And the fact that we have 35 years of private equity experience and that we have offices in 19 locations all over the world makes it very sort of seamless to effectively start turning on these little country faucets, if you will, to generate real estate related activity that's adjacent to private equity activity. So when you think about the method to the madness globally, starting with Asia, we're predominantly focused on China and India. They're very, very different countries, as we all know, but both economies have very strong GDP growth characteristics. They also have very strong population fundamentals in terms of the emergence of a middle class and the development of wealth in an economy that is trickling down to all aspects of the population. And so in both India and China, we have been very focused on playing the residential housing market and doing it in different ways. In China, we partnered with two publicly listed top 5 builders who wanted 50-50 joint venture partners, straight up, no promote, to help them build out of their inventory of land. And so we cherry-picked 5 sites from each company's balance sheet, and we set up 5 asset joint ventures with each of these 2 companies. And the strategy there is to JV with these companies to build for sale, middle-income, entry-level housing in the second-tier cities in China, like Dalian, which is a second-tier city, but it also has 9.5 million people. And the dynamics of the market in both China and India from a financing perspective is that when you sell for sale condominium product in these markets, the buyer actually puts up typically a 20% deposit, and that deposit can be used to finance your building. So unlike the United States where you put your money in escrow, in these markets you can actually use that capital to effectively create 0% financing for your assets. And then along the way, the consumer has to continue to post additional deposits so that at the closing table they're not showing up with 95% of the capital, they're showing up with, call it, 25% of the capital. And so in China, we went at it by picking best-in-class, large publicly traded companies who are going to be straight-up partners with us, who actually like the idea of co-branding with KKR. In India, we're actually going at it a different way. We're actually setting up what's called an NBFC, which is a non-bank finance company, which is in US speak, it'd be the equivalent of setting up a specialty finance company that's centric to the real estate space. And there are some very strong advantages that you have as a NBFC owner in India, the most important one being that you can get a direct perfected lien on real estate, whereas if we came in as an offshore investor and just tried to do a one-off deal, you're not allowed to actually have a direct lien on an asset. And so guys who blew themselves up during the cycle in India basically came in through derivative structures and didn't come in directly through onshore structures. And so because we at KKR have a local presence, we have a non-bank finance company in the corporate space, we're effectively leveraging that technology and creating the sister platform in the real estate space. And we're going to use that platform to originate first mortgages to residential builders at literally like 40 or 50% loan to value metrics, and you can get paid somewhere between 18 and 20% unleveraged for originating those loans. And in a real rate environment in India of, call it 8%, that's a pretty favorable spread relative to the risk-free rate to create a structure like I've just described. And so we're going at it a little bit differently in both those markets, but it's really an Asia, an India story, and a China story. In Europe, it's the exact opposite. The Asia story is effectively a growth play. In Europe, it's really how are we setting up to help the traditional real estate community get out of the toxic, distressed environment that it's currently in. The ECB in Europe has effectively done what the Fed did here and has allowed the banking sector to effectively have a long-term view as to how they slowly trickle out of assets. And so there, as Bob said earlier, there's not like this moment, there's not some moment in time where we're going to wake up and say, oh my God, you know, the distressed opportunity has come in Europe and we can all start writing checks. It's going to be a much more tactical and evolutionary strategy, but we all talked about it, you guys talked about it on the prior panel. There is a fundamental need in the commercial real estate space for capital. It's a capital-intensive business. You need it for leases, you need it for physical plant improvements, and over time, all the assets that were mispriced in Europe during the crisis are going to effectively have to come out or are going to have to be recapitalized with some fresh injection of capital. So we really spend our time in Europe either directly working with banks to help them deleverage or playing the one derivative trade off of that, which is to be able to provide capital to the real estate ownership community to either help them delever or to bring in new capital to provide capital for tenant leasing or for capital improvements, or maybe ironically to provide some growth capital to the market in Europe, because most of the capital that's been raised for Europe has been raised for distressed investing, and so there isn't really a lot of capital to fill the deleveraging void in the banking system to provide, for example, development capital. So we're in the middle of we haven't announced them yet, a couple of development projects in Europe where nobody who raised third-party capital to chase Europe can even look at these deals because it would be off message. But you're living in an environment where it's really, really hard to get even like 50% development financing in Europe in a world where 5 years ago you could have gotten 70 or 80% financing for development in Europe. And so when you think about that, there's a void in the capital structure that the developers can't fill, and they need somebody like us to effectively partner with to effectively allow for the capitalization to take place. So a long-winded way of saying in Europe, it's a combination of picking our spots to help the market participants grow who have the capability of growing and to effectively set ourselves up for continuing to help the deleveraging of Europe. If you think about it, the US banking sector is about 11 times levered, and even today the European markets is over 20 times levered. So over time the banking system is going to have to delever. It's almost inevitable. The one transaction you alluded to, just to illustrate it, what we've been doing is we actually bought into a mezzanine loan that one of the big money center banks had originated to a hospitality platform in Europe during the bubble. The bank never syndicated the loan. The loan was going to go into default. They knew that they couldn't effectuate a debt for equity swap because they would have to consolidate this hospitality company on the bank's balance sheet and all the employees on their balance sheet. So they brought us in to buy a joint control position, allow them to deconsolidate, and then we did a debt for equity swap, wiped out the fund sponsor, took ownership of this hospitality platform. We sold the German division to a South African family. We've completely delevered the senior debt, and now we own the remaining, call it 25 assets at literally on today's numbers, like a 12% unlevered NOI yield on trough, NOI. But that's one example, and the only deal we've done in 18 months in Europe. There's a ton of capital chasing deals in Europe, and so you got to decide, whether or not you want to win, or whether or not you want to be disciplined. So we've only done that one transaction, and then to bring it back a little bit around the globe, back to the United States, our strategy is really a combination of doing recaps, doing some structured equity investing, where we're not playing only in the equity, we're doing preferreds and converts. We're doing some platform investing. We've obviously done the investing in Williston that we talked about off of our adjacencies with our private equity verticals. And when you sort of look at that holistically, and again, just continue to think about how the brand can help you generate deal flow, there's a fair pipeline. The deal you alluded to in Albany really came out of our adjacency with our retail private equity business. We own Toys R Us, we own Academy Sports, we own Dollar General. The information that you get from those companies, not only in terms of how their businesses are doing, but in terms of how their specific locations are doing, and the knock-on effect that you can take away from that type of information is quite powerful. And so we bought, actually out of a receivership, a 1.5 million square foot regional mall in Albany that actually was a process where you literally had to bid on call it a Wednesday, you had to go hard on a Monday, and you had to close on a Friday. So there was no due diligence period. We had to do all the work up front. You had to have a lot of conviction around what was happening inside that mall, and we were able to use our own retail private equity look-through information to help us get conviction around that asset and a couple other assets that we bought in the retail space.
So when you said that time frame, I almost fainted. So from a risk management perspective, and just things like underwriting risk, and just, is it such that the returns are just that's where you're getting compensated for taking that sort of timing, issues?
Well, yeah, to be candid with you, yes and no. I think that first of all, you had access to a data room, and you could effectively reconstruct, if you wanted to spend the time on it, which we did. You could reconstruct effectively an Argus model where you could create your own P&L, if you will. The risk that you were taking was that either there was fraud in the data room, or that you felt that there was some structural problem with the asset, either environmental or a structural problem that would cause you sort of small deep hole risk. And so you can do a lot of intuitive work off of the information that was available to you. So, for example, the prior owner was Heitman. So we sort of understand, we know Heitman well, we know how they underwrite, we know what work they probably did just to get the deal approved when they bought it back in 2006. We also saw the structural reports, the environmental reports that were done at that time. We also know that the asset was financed, and so we know that the lender did their own work, and we know the law firms that everybody used, and stuff can happen, but if you sort of connect the dots, your inference would be that everything was probably okay, and that there wasn't anybody who was fraudulently conveying information to you. We also had the benefit of knowing that Whole Foods was coming into the center opening next spring. We've got a very strong relationship with Whole Foods, and we know sort of how they underwrite and pick locations to open new stores, and so we were effectively extrapolating off of their information to effectively conclude that our underwriting was probably a sound underwriting. But back to the comment I think that Bob made earlier, This is not the 1990s, right? Where back when we started Whitehall in 1991, there were really like 4 players in the world who were chasing deals, who had lots of sort of opportunistic capital. We're dealing in a world today where there's tons of capital out there, and in a deal like the one in Albany, we're not only competing against private capital, but we're also competing against the public players. It's just that we've got the benefit of being able to do something in a week where a lot of guys just can't get their head around a process of that duration. And secondly, in the panel earlier discussed this, the private market does have the benefit of having access to more leverage than the public market implicitly. The public market has cheaper leverage, but they're lower levered than the private sector. And so with 60% financing, we can compete against a public company who might be thinking about it with a 30 or 40% cost of capital on the debt side.
It seems like a lot of, it seems like a lot of what you've been buying recently is retail, or you've had a fair number of deals, the Kansas City Legends deal that you bought in foreclosure as well. So you're making, a reasonable bet on retail. So, what's your sort of, thinking on just that space? We talked a little bit about it earlier, sure. But it's very traditional retail that you're sort of getting.
Sure. And I think you guys alluded to this concept on the earlier panel, which is, all these things are idiosyncratic in terms of the actual fundamentals at the property level. That's sort of an obvious statement. But the fact that retail has been effectively dismissed by the public large players in the space with respect to what we call sort of the B-mall concept. So, assets that have sales per square foot of inline tenants of, call it, less than $400 a foot. The major big players in the public space have dismissed that asset class as being sort of not core to their strategy. And so you sort of ask yourself the question, are there certain demographic locations in certain trade areas where if you had access to some of those types of assets, could you effectively create a lot of value with more tender loving care and operational focus than had been given by even some of the best operators in the space, being the large public players. At their own admission, if you even listen to them on their earnings calls, and Marty is literally the key banker to many of them, they self-acknowledge that they just don't have the time, energy, and focus to dedicate to some of these assets that are in secondary markets and that have sales productivity that might be very good, but not where the REIT analysts want them to spend their time. Plus, when you couple that thematically with the concept that we do have this retail industry vertical at KKR that we can leverage off of for access to retailers and for information from our own captive retailers that we own, you do start to convince yourself that there is a differentiated approach to how we might be able to underwrite some of these assets. And then you layer on top of that the operational intensity of a regional mall. They are complicated animals to lease and manage, and how you think about expense management and reimbursement strategies and branding strategies and procurement strategies, those types of things. We have a team of people at KKR who do that for our portfolio companies in the corporate sense, and we leverage those best practices when we buy regional malls as well. So when you add it all up, it seems sort of a natural place for us to focus because of the retail industry verticals, the operational intensity, the fact you can access financing in a very efficient way, and the fact that the traditional strategic players in the space have sort of dismissed this segment of the market as something that's not strategic to them.
It's funny, in the earlier comment of demand, we're still in a supply and demand business and always will be. But to Ralph's point, clearly we're representing Westfield and have been for quite some time, who publicly stated they want to, sell the assets downscale, have moved some and will continue to move others. But the whole mall business was the catalyst for the consolidation in the public marketplace. That's where the most transactions were, starting in the era after the IPOs. And candidly, the skill set's going to be picking the 1 out of 20 or 25 that They used to die very slow deaths. Some of them will die at a much more rapid pace. But, you know, I do think that's an area, and I think clearly Ralph and his team have, you know, done a good job of trying to focus, you know, and really pick the ones. But you got to be nimble, you got to be quick, and you got to have a viewpoint determined pretty quickly.
You talked a lot about just the integration of your verticals, and how do you do that, just from a overall sort of company perspective, when everybody's running in their sort of direction, and that you're getting this sort of sharing of information in disparate areas, and they're not, I mean, do they wake up thinking about real estate to some extent, and how does that work?
Right. It would be naive to think that the guy who runs the energy business, you know, every morning in the shower is thinking about, you know, how can we create a real estate deal? That's not reality. But it is reality that at KKR, all the people at KKR are paid off of one P&L and one global promote bucket, which is a very unique cultural attribute. So in most private equity firms that are of the likes of KKR, that the guy who runs the real estate business has direct piece of the promote in his business. He owns a piece of his P&L. His team owns a piece of the P&L, and they're largely separate from the success or failure of people in other industries or other product types. At KKR, it's what I described, so we all have a like-minded culture and mindset to try to create opportunities across these various businesses to create a more lucrative pie at the top co. Okay, so there's a cultural bias that creates an environment that promotes what you're asking about. The second piece of that culture is that we literally sit adjacent to other private equity teams. So I sit next to, just the way it's laid out, I sit next to one of the partners in the energy space. The guy who runs the retail business and I talk weekly. It's just the culture is set up to try to figure out ways to create differentiated investment opportunities both ways. So we've got a team of guys who are our operating partners in the mall space, and so every quarter we have a conference call with the guys who operate the malls and our retail guys to tell them about the new retail concepts that we're seeing in our assets and that these guys are seeing in other assets that they run that they think are sort of the up-and-coming retail brands that our private equity team might actually want to go and approach about investing in or buying. So, you know, I've got a cultural responsibility to try to create the next Academy Sports deal or the next Dollar General deal, where my information might be helpful to the guys in the retail industry vertical. So it works both ways, and you know, it's like anything else in life. If you have one or two examples of where it's success, you know, success breeds success, and it's sort of a snowballing effect in terms of trying to create more connectivity across these businesses.
If I may, too, we're well trained. There's a little firm called Goldman Sachs that had a culture that, you know, at one given time, from competing for many, many years at Merrill Lynch against them, I felt like everyone at Goldman knew everything. And, you know, a lot of it comes down, we were in a partners meeting at Evercore last night, and Roger Altman got up, and it's very simple. It's communication, and you got to go work at it. Yeah. But you touched on another point, too, that, you know, is the operating team you put together, because I assume it's as much finding the right teams and partners that fit the deals as, you know, is a large part of the skill set, and obviously you've invested a lot of time there. So
yeah, I mean, to Marty's point, when people ask me what I do, I don't say I'm a real estate guy. You know, I'm not a real estate guy. I'm just a finance guy. Just so happens I'm a finance guy who understands how the real estate industry works, but the real key to the value proposition is what you do at the bricks and mortar level, and what kind of conviction you have with the team you have either internally or externally who's effectively aligned with you to create value at the asset level. So to Marty's point, we spend a lot of time developing our own either exclusive or semi-exclusive relationships with operators who effectively co-invest with us. Their interests are aligned. They get paid warrants or promote in transactions, but we spend a lot of time vetting those operating capabilities.
So that was an interesting question I had too, is that, a lot of LPs got burned in the downturn with GPs that were, when sort of rubber hit the road, was not so good. So how do you vet those partners and what is kind of the process? And especially you have the global context of you're doing it all over the place with people that, so.
Well, I mean, the vetting starts, there are a number of levels. One is reputationally, how they are literally perceived in the marketplace. So we do exhaustive background checks on all of our partners. That goes, whether or not we use Kroll or other agencies like Kroll. We spend a lot of time reviewing information as to how the protagonists are perceived, not only in the business community, but also in the social community. There's one thing that, when I came into KKR, there are three things that Henry Kravis and George Roberts told me to be worried about. The first one was brand, the second one was brand, and the third one was brand. And so they spent 35 years creating a best-in-class brand in the finance business, and they didn't want me to dilute that brand. And so we spent a lot of time just vetting the reputational prowess of the partners we do business with. Then there's a whole operational vetting. We have a team of people at KKR called Capstone, who are Booz Allen consultants and McKinsey consultants, guys who grew up literally in operating capabilities inside of companies, and they are internal consultants to KKR who go into all of our portfolio companies, into these operating partner platforms, and actually do almost a forensic underwriting for us, which is something that I'll bet you nobody in the real estate private equity business ever did. Even when we were I helped build Whitehall at Goldman. We didn't even do that at Goldman for the most part. So, it's not all science. Some of it is art, but it's an exhaustive exercise to find the people you really want to do business with, because you are indeed co-branding with them, and you have to be very careful about picking your partners.
One of the things I thought was interesting too about what you're doing is you're effectively starting a business within KKR from scratch to some extent. You've done, there's been some real estate involvement before, but you're really the first guy that's really leading that charge. So, what have been the challenges that you didn't expect since you came? I think it was in 2011, March of 2011. What have been the surprises to the good, and what's it like managing a global business and kind of starting it from scratch?
I would say most of it has been a very positive experience. As Marty alluded to, I'd come out of a culture at Goldman where I spent 18 years at Goldman and helped build the Whitehall brand globally. And that was a similar exercise where you were taking a mature organizational brand globally and effectively starting a new business leveraging that brand. And so the exercise at KKR was sort of very analogous to what I had experienced at Goldman, albeit when I was at Goldman, I was the young guy on the totem pole, and here I've got responsibility and accountability for the effort. So I would say the benefits have been, number one, you get access to all the information we talked about. Number two, we have a balance sheet. So all these deals that we've been talking about have been invested with our own capital and the capital of KKR Financial, which is another publicly listed company that we control. And so having access to capital in this environment without having to go out and raise capital has been a huge competitive advantage. Thirdly, the flexibility of that capital has been a huge advantage because we're not siloed into just being distressed guys or only being able to do deals where you earn an 18% IRR. We can do deals that are lower return but lower risk and higher up in the capital structure, so that's been a big advantage. And then again, coming back to brand, I mean, I'm very fortunate. We get a lot of reverse inquiry from the marketplace, people who want us to partner with them, and reciprocally, if we want to get access to somebody in the real estate business, odds are we can get there because we have KKR on our business card. And if I were starting my own business, I think I'd be dead in the water. I mean, you guys were talking about earlier, it's a mature industry, and there are a lot of asset allocators in the industry. And so ultimately, if you're a institutional investor, you have to ask yourself, does the world need another asset manager in the real estate space? I would say the answer to that would be no. But if you have KKR as your manager, I would argue the answer is probably yes, because you can turn on that faucet of the KKR brand and everything we've discussed, and it's not a pie eating contest. You just have to see, you have to believe that there's enough differentiated deal flow that comes out of that faucet to be worthy of people wanting to potentially invest with you one day.
And then, you know, I mean, if you think about your direct competitors, they have, to some extent, some of the same, you know, kind of benefits. How do you compete with you know, sort of others?
Yeah. Well, you're talking about competitors in the private equity space? So I think you have to put Blackstone in their own category. You know, they manage close to $60 billion in real estate. You know, relative to we've invested $700 million. So it would be disingenuous to say that that we compete day to day with those guys. But on a corporate large deal, it would be certainly logical that we would run up against each other. But for the most part, on deals where we're investing, call it less than $100 million of equity, which is for the most part all the deal. We've only done one deal where we've committed 150, which is Williston, and a second deal that we've committed over 100 in a convertible preferred to a private REIT. For the most part, these deals are sort of $50 million equity checks. In terms of competing against the likes of, call it a TPG or an Apollo, who are the other big players in our private equity space, you know, each of these guys gravitates towards different themes and different types of risks that they want to take. TPG has been basically focused on platform investing, largely, I think, because they were accessing their private equity fund, which had a mandate to invest only in platform opportunities, as opposed to asset level opportunities. So we haven't really run into TPG very much. We've done one platform deal that we competed with them on, that we were the winning acquirer of Sunrise Assisted Living, which is a senior living healthcare company, but that's really the only time we've really run into TPG. In this mall strategy that we've alluded to, really TPG is actually playing in that space, but interestingly, in a process that we're involved in right now, we've gravitated towards certain assets and they've gravitated towards other assets, and so we really haven't really beat each other up. And then, you know, the market is huge. I mean, you guys were alluding to earlier in the earlier panel that whatever 80% of the market is in private sector hands. That creates a lot of fragmented opportunities in the space, and so there's a lot to go around in terms of needs for capital and providers of capital. So I don't really worry about the competitive landscape very much.
And it's in the queue, whether it's in the open-ended funds, you know, we're washing capital, that's for sure. You know, you know, it's ironic if you look back, because, you know, the void that the large private equity firms are filling in the marketplace today is candidly the void that was left by the financial institutions. So with Lehman Brothers, you know, Bear Stearns, a lot of equity players, and then going forward, their inability to really get back in that business near term, and you know what the impacts of capital regulations, Dodd-Frank, everything is on it. And you know, it's interesting because you know the global footprint that you have is how the investment banks were the first ones to get to the global real estate market. It was a natural entree as real estate grew as an asset class and as an investment vehicle, that the investment banks had the global footprint. That's how you got in it, whether it was Goldman or Morgan. You know, and candidly, the private equity firms and their evolution and the depth of companies and expertise they have right now, but it's, what, 19 offices around the world? You know, it gives you the infrastructure to play.
One point that Marty made that's super, super important is that the competitive landscape in real estate was not just third-party managers of institutional capital. It was largely driven by the balance sheets of the major global financial players. So just to give you perspective, when I helped build and run Whitehall at Goldman, and I left that business in 2003, and I went into fixed income at Goldman and co-ran a series of proprietary investing desks inside of fixed income, so it was all Goldman Capital. That business ran our mezzanine real estate lending business. It had a huge book of bespoke B-piece investments in commercial real estate securitizations. When I left Goldman in 2006, that business was $22 billion, all Goldman capital, okay? That business today is less than $5 billion. So if you just think about it, the deleveraging of the financial markets or the financial institutions has restrained that type of investing activity for not only for Goldman, but as Marty alluded to, there's no Bear Stearns anymore. There's no Lehman Brothers anymore. You know, the Merrill desk was a huge prop player. That's gone now. I mean, so you gotta understand that not only did the asset managers have missteps during the crisis that has resulted in a lot of redemptions and the firing of the real estate private equity community, but also the banks have basically deflated their balance sheets to an extent where they're not really competitive in the real estate space either.
So why don't we open it up to the audience if there's any questions? I see one right there.
Good afternoon. Thanks so much for being here. You mentioned China earlier, and I was interested what your perspective is or what your assessment is of the potential real estate bubble that everyone's talking about in China. Secondly, what are your thoughts on the fundamentals in China, specifically to the residential that you spoke of, with the rate of urbanization that is expected to continue to grow and really be huge, that led you to choose tier 2 cities as opposed to tier 1?
Yep. Great questions. I think the conclusion that you drew at the last part of your comments is sort of the key to what we're doing, which is that there is a lot of capital in Beijing and Shanghai. And no differently than how we see in the United States, there's a lot of capital in New York and in San Francisco and the gateway cities here. There's been an influx of capital to the cities that people have heard of and have traveled to in China. But just like in the United States, there are opportunities in Kansas City, Kansas, or in Chicago, Illinois. If you believe in what's happening at the economic GDP level in the second tier cities in China, there are implicitly ways to make money in these marketplaces. So we have a macro economist team at KKR who actually literally just came back from China last week, and we're analyzing this question for us and making sure that we as a firm felt comfortable with the fundamental bet that we were making in these secondary cities, and that we were, quote unquote, trying to make sure that we were avoiding any bubble type behavior. So we have sort of that check and balance internally. The second comment is that while we have these sites for development ready to go, we're not building all 10 at once. So we're doing these serially, so you can't really get too far over your skis in terms of having too much long speculative exposure. And secondly, once you put the foundation in the ground in these assets, you get so much pre-sale activity that you can sort of de-risk the deal pretty quickly based on the amount of deposits that you're getting effectively up front before you start doing a lot of vertical construction. And you can sort of see your path to how you're going to self-liquidate out of these assets. And it's not coincidence that we picked an asset class that was a self-liquidating asset class to play in, because we were worried in terms of what we were observing in Shanghai and Beijing that guys were going to pay up for assets and there was going to be some type of an asset bubble and it was going to be hard to exit over time. Plus, obviously, the more long-dated your holding period is, the more political risk and currency risk you have embedded in the transaction. In the deals that we're doing, the duration of these apartment building trades are really sort of 18 to 26 months type thing. So you're not really getting too much over your skis from a macro perspective either.
And then you sit there and look and say, yeah, these are tiny little towns of 8-9 million people.
Right. It's amazing. I mean, if you ever go to one of these places, it's quite amazing. Exactly.
Question I have for both of you. Earlier today, President Obama proposed a budget that wants to tax carried interest as ordinary income. How does that affect our industry and each of your prospective firm strategies, if passed?
Well, it would certainly have an impact on the industry, but I think the interesting question is going to be whether or not that bill, I haven't read it, but whether or not it's going to go after the individual entrepreneur who's the developer in Cleveland, and whether or not he or she is going to start paying ordinary income tax on carried interest. And I think when the debate really starts resonating and people understand that it's basically somewhere between not logical and potentially discriminatory to sort of bifurcate the marketplace between guys who are institutional owners of real estate and the woman in Cleveland who runs her own self-propriety shop. I think the debate will get more complicated.
I mean, it's going to be a long debate. A bunch of us will be here a lot more. It's not a surprise to anybody. Ralph's got a little bit more conflict than I do because it's to where it is. Although as Evercore was originally put together and taken public, we have a bit of that issue as well as partners. But there's going to be, I think, from the fundamental real estate business standpoint, I think there are enough people that understand the differentiation in the money management part of the business, whether it be private equity or hedge funds. I think that's going to become a separate argument.
So if you were, call it 22 and looking at graduation, or you were 28, MBA looking at graduation, or maybe even earlier when you're sort of going through your academic career, what should you be thinking, or what should our students be thinking and doing right now?
This was not a scripted question, because I've given this advice to young people who come to see me pretty frequently. I think that people who want to be in the real estate business today have to decide what's motivating them and what they want to achieve over their career in terms of types of responsibility, types of intellectual stimulation, and also financial wherewithal. And what I say to everybody is it is a mature business, as we've discussed. There are lots of different ways to play the real estate industry. There are guys who are bricks and mortar operators, there are guys who are asset managers, there are guys who are financial intermediaries and advisors. But the overwhelming advice that I give that most people don't like is that they shouldn't look at my career, or for that matter, Marty's career, and think that they can have a similar career trajectory over the next 25 years that looks like what we were lucky enough to be a part of over the last 25 years, largely because we were a part of an industry that was a very small and immature industry in the capital markets. And in different ways, Marty and I both helped create a mature industry and benefited personally from that creation. And so when you step back and you ask yourself, okay, it's a mature industry, what should I do? What I tell young people is that they should go where GDP growth is, because historically 90% of the money that's made in real estate is made because it's correlated to GDP growth and employment growth and consumption. And so if you believe that, then what you really ought to do is you should go to some other part of the world that doesn't have an oversaturation of real estate investors in it, where there's too many money managers, there are too many developers, there are too many guys in each industry sector, and they should go to South Africa, or they should go to India, or they should go to China, or they should go to Argentina, or someplace where they actually have conviction that there's going to be growth. Or, and I mean this seriously, what you ought to do is you ought to graduate from Georgetown, you ought to move to Williston, North Dakota, and you ought to get access to capital, private capital, and you should help build the Bakken oil shale, or go into the heart of the Marcellus shale. And when you're, I've told this to, I don't have children, I've got an 18-year-old, but I don't have college graduates. if you're young and you're mobile and you really want to learn the real estate business, go there. You know, think about it. Every guy, the number one Ford dealership in the United States is in Williston, North Dakota. The number one Walmart in the United States in Williston, North Dakota, okay? We're building an apartment building in Williston, North Dakota to a 17% unleveraged return on equity, okay? Okay, 17%. And every time I tell a young person, you know, why don't you move to Williston, North Dakota, they're like, oh, Jesus, like, there's nothing to do in Williston. I'm like, well, it depends on what motivates you. If you want to do something really interesting that's centric to the real estate business, and by the way, you can make like an infinite amount of money, you know, it'd be a good place to go. So that's my advice.
It's funny, you know. I swear to you, I stopped in Baltimore on my way down here today and had a meeting about low and moderate housing in South Africa. You know, and you took my line because my daughter Annie is moving to North Dakota after this meeting, I'll tell you that. All right. But if I may, first of all, thank you for everyone's benefit, Ralph just landed from Seoul and changed his schedule dramatically to join us. Yeah, that's right. And two, the other messages, thank you for, sharing clearly a wealth of experience and the direction. But I have to make a comment that as you grow this business, and I'm sure you will be as successful as you've been throughout your career, please keep in mind there's a lot of bright people here, and you're here to really, help really reinforce what the commitment is here, and we're turning out some very bright, intelligent, hardworking people, and some of them will still be left to move to New York who aren't in North Dakota.
Sounds good. I look forward to that. Thank you guys for having me. It really was a pleasure.